Yeah. Hello, everyone. Welcome and thank you for signing in for this webinar. My name is Hemant. I am a VP of Product Management at Kred. I have with me Vivek Raghavan. He is co-founder of Tezzract, and Tezzract is one of the fastest growing MSME lending platform. Vivek is having over 15 years of experience, and he prior to Tezzract, he has co-founded Kapital, which was also a MSME lending platform, and he carries with him around 15 years, more than 15 years of experience in financial services. Welcome, Vivek. Nice to have you on the webinar.
Thanks, Hemant. Yeah, likewise, happy to be here.
Yeah, so let's quickly jump onto the topic that we have today. So we are discussing about optimizing cash flow with new age credit instruments. So that is something around we will be discussing, and so let's start with the discussion. And to start with, I would ask, you come from a credit background. You have built two companies which are into MSME lending. So how credit plays, what role credit plays when it comes to smooth cash flow for a company?
Yeah, I mean, definitely, timely credit is super critical when it comes to expansion, particularly. So it depends on what sectors you are in. So are you a manufacturer with a certain receivable component, or are you a contractor? That's a very different receivable cycle. Or if you're a trader, that's a kind of a different profile of receivable cycle, right? So, and then there is the, across the counter, like a retail format where you liquidate inventory across the counter and generate cash. Yeah. So there's no significant receivable component in the retail segment. But a trader is one module where you can quickly scale up revenues by adding timely credit, right? So you can, if you're able to instantly generate credit, you can instantly match them to specific orders that you're getting as a trader, right? So that's very, very quick to add. On the contractor side, they have long cycles, sometimes dependent on large corporates or quasi-government or government entities. So for them, even although they have higher margins structured in, for them, the timing of when they will be able to kind of liquidate their when their receivables will come back through is something which has various procedural hassles linked to those. Right? And a manufacturer has it's more around working capital expansion and other working capital features and his ability to increase his capacity utilization, right? So that's broadly, that's how I would say that all of them have criticality, but each in slightly different nuances within these MSME buckets.
All right. And does the credit evaluation and way of credit assessment also varies with the different type of companies that you talked about?
Yes, significantly. Because for a contractor, it's more about if there are rich margins and there's rich amount of execution experience built in. So we know that he'll be able to continuously churn his receivables. So that's slightly different. On the manufacturer front, again, it's more about whether he has enough cash flow coverage to service the kind of capital structure that he has, if it's particularly leveraged, right? So, so once his production capacity and his offtake is somewhere able to service the debt, that's kind of comfortable. For a trader, it's just about collections. It's more about collecting back money as a business for a trader, I would say. So in some sense, a trader is also is a more focused, localized lender in the role that he plays.
Yeah.
So the models will be different as to, for a trader, it would be a default rate. For a manufacturer, it would be debt service coverage indicators. Yeah. And for a contractor, it would be his track record overall.
All right. And how do these cash flow challenges vary when the company grows in size? So from the small company to a larger organization.
Correct. Okay. Yeah. So sometimes channels have limit. I mean, your financing sources will have limitations, like whether that requires you to furnish hard collateral, right? That could be one sort of limitation. So sometimes larger profiles with large mortgage collateral availability, sometimes they're able to finance a longer time into their growth phase. But other guys who have similar business opportunities but don't have hard collateral, they might face some limitation there. There's been some reduction in that due to the government going gung-ho on CGT MSC, where you have collateral-free lines of overdraft cash credit available. So that's kind of been a very, very good bridge in the last 2 years. There's been a large increase in even private banks. Earlier, this being a domain of public sector banks, now private banks also offering CGT MSC backed facilities of easily 1 crore, etc., provided that the business is healthy. So that's kind of eased the requirement to provide large mortgage collateral to get these kind of rotational facilities, working capital facilities. But then after a phase of growth, then it becomes more about and if you are not a trading model and you're more about manufacturing, etc., it's about your debt to equity ratio. So you may need to increase your equity capitalization as you go up. You might hit, as a larger business, you always hit ratios which banks closely monitor, whereas when you're a smaller business, those are not as hardly as not strictly monitored, and you have smaller NBFCs who can furnish with lower diluted norms on that. But as you go larger, you have to move from NBFC financing to bank financing. Then you hit ratios as you cross 2 or 3 times your net worth. It becomes challenging. So then equity infusion becomes the challenge for larger businesses.
And even for the smaller companies, there are fintech players who are targeting them as well for the financing. So they have ample channels to get financing from. While for the larger organization, the rate of credit or cost of credit is very, very specific, which only large banks can fulfill. That is also, I believe, one of the...
Right. Unfortunately, today, the fintech world is kind of synonymous to high yield credit or serves, right? So I think over time it should become fintechs will move to becoming platforms and enablers, where they will also be able to connect lower costs of capital, particularly from large private sector or public sector banks. But as of now, because it's more focused on short term credit and the lower rung of the segment sometimes, where there is a lower credit penetration, sometimes the yields appear a little higher than what large borrowers are used to. But once that platform effects kick in of fintechs, I think in the future we'll be able to cater to larger businesses also.
All right. And we discussed about the different sizes, but when we talk about the different sizes, there is a speed of transition as well.
Yeah.
So let's say there are a hyper growth companies which are in a very short time, they turn from MSME to SME and further. So those hyper growth companies, how they see as what are the main parameters they evaluate while deciding from where to get the credit, and from the other side, when the lender sees those kind of companies, what their thought process is. So could you throw some light over there as well?
Yeah. So as for them, the opportunity to cater to a revenue opportunity, right, or the ability to cater to a revenue opportunity is more important, so that they can maintain their presence and credibility to that customer segment. They are not seeing some of these opportunities as pure profit-making opportunities. They might say, today, if I'm able to work with, let's say, a large inventory-based trader who's able to set up a warehouse facility and stock up inventory for, let's say, somebody like an Amazon, right, in India, on a specific project, a product line where he's been working with Amazon. Amazon comes and says, why don't you maintain at any given point 20 crores of, or 10 crores of, inventory for me? For him, the opportunity to display credibility with that large partner or with a large corporate, etc., that becomes more important than the cost of financing. And so therefore, they might look at very mixed cost of financing from where it's available, as opposed to optimizing the cost of financing, right? So they might look at private gray market sources. They look at friends and family. They might look at investor, individual and high net HNI guys, and then banks and NBFCs, because their need will never get fulfilled in such a short time. Because usually the larger banks who can kind of really support this have they look at annual reviews of how your working capital performance has been, and it goes rather than a quarter to quarter or a month to month kind of opportunity outlook for them. It's about an annual growth opportunity. So sometimes if you're really growing fast, those yearly reviews become your limiting factor, and that's where you also have a few people looking at revenue financing opportunities in the fintech space, where they fund you on revenue levels as opposed to other financial parameters. So
this is another alternate mechanism of lending. All right. When it comes to the traditional finance versus new age tech-enabled finance, where do you see the major differences and how things are changing?
So there's always been this conflict of what are the strengths, weakness of each of these segments. Maybe for the fintech universe, it's about being young at this point, and maybe cost of financing being a slightly limiting factor. But at the same time, what fintechs bring to the table are innovation and speed, and timely credit, and hassle-free experience, frictionless experiences, if you want to call it. Whereas the traditional lenders look at lower cost of financing as their strength, but that comes with a lot more documentation, lot more being well documented in all areas of financials, reporting higher numbers, clearer numbers, etc., which might take businesses a certain time to get organized. Or smaller businesses are not in an environment where that really fits them well. So I think that's the thing. Like I said in the earlier point, that sometimes they look at annual horizons, whereas small businesses have a quarterly or monthly horizon in terms of how they look at their growth and their activity. So that's where it is, and the level of documentation required. But I think over time that's going to get reduced because banking penetration has increased. Overall, people are more happier looking at businesses are increasingly operating with higher penetration of banking. UPI has also created that multiplier effect. GST compliance levels have really gone up, and today you have about 1.2 crore MSMEs, which are 9 MSMEs registered in for GST, of 90% of whom would be proprietorships. So because of the data getting more organized going ahead, and bureau penetration over the last 10 years has significantly really improved, giving lenders more clarity on past credit behavior. So I think going ahead, even the traditional institutions, if given time, they will also start moving in with innovation, sometimes in partnerships with fintechs, because they might really not have innovation teams which will come out with great products.
All right. So you have partially answered my next question, that is why it is and how difficult it is to get timely credit from a traditional financing organization. But what do you think are more further, elaborating that furthermore, why there are challenges and what can be done to overcome these challenges?
Challenges are primarily because the decision, the kind of credit knowledge that exists in the system in traditional lenders, which is able to understand the customer and say, this is what I'm comfortable with, comes from the front end, where more relatively junior people in the credit network are in direct touch with the customer and are able to derive comfort, right? But they don't have influence on policy making. Right, and the people in these organizations where they have policy making power are fairly maybe away from the end customer. So because the kind of innovation framework, the people who have the ground knowledge to innovate or give input into innovation don't have access to policymaker levels. This obviously that's how the hierarchy is required for such large organization to function. But this distance in decision making to customer interface. That's one of the reasons. And they look at wide range of activities and customer facilitation in terms of products and services. So newer organizations have much more focus, start with monoline focus on credit offerings, and then add adjacencies to those monoline, rather than go ahead and say, I'll do housing, I will do secured, I will do working capital, I will do revenue financing. We don't. That's not how fintechs look at it. They pick up, okay, let me look at revenue financing, and then is something more closer to it. So can I look at some sort of ancillary product and keep building adjacency products? So for both these reasons, I think that's the core difference where a fintech is able to come out with more tailor-made solutions for MSME businesses.
Yeah, that is I mean, interesting insight of being like who is in touch with the customer, and that changes the ball game in terms of timeliness or short duration of decisioning. That is something interesting. So now when it comes to technology, so how technology, I mean, obviously we know technology is changing the way the finance or any other domain functions today. But how technology can enhance and add more value and bring in more innovation in the credit space? What do you think?
Yeah, so the easy birds, two or three top things which come to my mind is, one is templatization of credit models, so that they're more scalable, and in terms of not having also high level of human dependency, right? That's important. So technology is required to sort of allow that templatization to happen through data feeds, so that credit is slightly more standardized. That's one thing that will make it more scalable, less dependent on specific humans to be very smart to interpret risk, particularly in MSME businesses. And the other is cost of delivering credit, because the larger institutions have very large branch-led models with significant infrastructure in terms of people and physical infrastructure to kind of locally cater to that, right? So by using technology to build platforms which today, with the high penetration of mobile and internet access, can bring platforms onto your phones or onto your devices, right? And kind of bringing the branch to you, as opposed to you going and visiting a branch or being branch dependent, and again people dependent in that sense. So I think that's the future. Yeah, so these are two top things that I would look at.
Yeah, sure. So another question was around the seasonality, because when MSME businesses are looking for financing, or even, I mean, the larger businesses are looking for financing, so whatever their average demand is, that is fulfilled by most of the financing partners they have. But when there are spikes in terms of seasonality, so what are the ways how they can cater the credit demand during those times?
Yeah, you're right. People are able to kind of get a working capital facility of a overdraft or CC, which kind of takes care of their base credit requirement, maybe some of their own equity in the business, and then remainder of it comes from spike in seasonal demand.
Yeah.
And that's slightly different from what we said the other way in terms of high growth, which is a very different sort of demand. This is to festive demand, or different cycles in different products that they're handling. So traditionally, this has been catered to by the private financing market, where you have your local money lending system, or chit funds kind of catering to it. So there's and these are at significantly high rates and at very short tenure products, from 3 months to 10-month products, right? So we have an opportunity to really organize it, because in the same way that if you look at larger gold loan companies, they never invented the product. They only organized a local money lender product, the gold loan, and they kind of made it into a more but in the process, they brought the cost of financing down significantly by organizing it, and they have more transparent ways in which they operate. right?
Even this is one of the problems which many of the customers we work with, they also were coming up with. And we also tried solving this problem. And what we found is mostly when it comes to slightly bigger businesses, they have a corporate credit card available with them. And when it comes to MSME businesses, generally promoters have credit card, personal credit card on which they have decent limit. And what we have done is enabled the usage of credit card for the vendor payment or any of those kind of expenditures. And that is, I mean, a very, I mean, it is a fast growing product. It is picking up in the market. People are seeing credit card as this alternate source of lending where whenever there are spikes or anything in the business, so they are using it as a contingency. So this is some market problem. We combined it using technology and tried solving it. So we see good traction over there as well.
No doubt. I think this is a fantastic solution. I think there are now banks looking at, offerings where you can also use a credit card to finance your GST payments if required. Because timely GST compliance is so critical. And there's a lot more features you can play around with.
Utility is another area. Even the interchange or the rates of utility bill payments are significantly low on credit cards.
Correct.
So
correct.
That is another area. Yeah.
Correct. And also, if you see the larger credit card universe as a consumer product, even though there's sufficient penetration in sufficiently large penetration in the urban areas, with the top 5 banks almost looking at 100% of the market share. They only have 15 to 20% of penetration to MSME customers. So that means even in their individual card offerings, which are slightly similar limit, they don't focus on MSME as a segment. So if you come out your product offering, which is fairly super focused on MSME and MSME end users, that'll be something with a large, a large opportunity to kind of cater to demand.
Yeah, great. So it was really nice talking to you, Vivek, and you shared some priceless insights about how the industry is working. And just to, conclude, the different types of businesses have different types of credit needs and different way of assessment is required for them. So technology plays an important role in bringing down the timeliness of like how quickly the financing can be done and how efficiently the financing can be done. So great insights, and look forward in the industry the disruptions you bring in through your company. Thank you for being part of this webinar. It was a pleasure talking to you.